some of the most dangerous trades I've ever taken didn't come from bad strategies, they came from unfinished ones. If you've been trading for a while, you know this pattern. You're scrolling, watching, learning, and suddenly you stumble onto a new edge, a YouTube setup, a Twitter thread, a Discord idea, a shiny backtest, a new indicator combo. You look at a couple of charts, you see a few perfect examples, and your brain goes, "This looks good. Let me try it live." No full testing, no real statistics, no tracking across different markets and conditions, just a handful of screenshots and a feeling. I've done it. You've probably done it. And that's what I call the untested system problem. It's not that new ideas are bad. Markets evolve, tools improve. We need new edges, new angles, new ways of seeing. The problem is how we use them. We grab a raw, half-baked concept, slap money on it, and then act shocked when the market treats it like just another random bet. When I started going deep into Jesse Livermore's story, not as a meme, not as a quote machine, but as a trader who lived through wild bull and bear cycles, one thing became very clear. He was suspicious of anything new that hadn't proved itself through time and through tape. He didn't trust opinions. He barely trusted his own instincts. What he trusted was repetition, seeing the same behavior again and again under different market conditions, until he felt he could say, "This is not just an idea. This is a tendency of the market." Today, we do the opposite. We discover a pattern on Friday and want to size into it on Monday. We see 3 charts that fit and call it an edge. We confuse fresh with tested, and pay tuition to the market because of it. In this video, I want to take you on a kind of psychological autopsy of that mistake. We'll unpack why your brain loves untested systems more than boring, proven ones. How the endless stream of new ideas online quietly destroys your ability to stick with anything long enough to see if it truly works. What Livermore actually did before trusting a new method with real size, and why he'd rather sit out than experiment with his main capital. A real story from my own trading where a fresh, exciting system nearly wrecked a good month because I treated curiosity like conviction. And finally, a concrete framework for how to evaluate, sandbox, and earn trust in new systems without letting them blow you up. Because here's the uncomfortable truth. Most traders don't blow up because their system is bad. They blow up because they never actually had a system, just a rotating list of untested ideas they kept upgrading every time the last one hit a losing streak. If you've ever said to yourself, "Nothing works for me," it might not be the market that's the problem. It might be the way you flirt with new ideas instead of committing to tested ones. In the next section, I want to dive straight into that inner war, the paradox of being a trader in a world overflowing with strategies, wanting stability, but addicted to novelty. That conflict is exactly where the untested system problem is born. There's a strange tension that lives inside every serious trader I've ever met, including myself. I want consistency, but I'm addicted to newness. On one side of my brain, I know exactly what I need. A system I understand, rules I respect, setups I've seen 100 times through both good and bad conditions. I crave that feeling of walking into the market with a clear playbook, knowing what my A+ looks like and when I should simply step aside. But on the other side, there's this constant itch. The itch to tweak, to improve, to try the new thing everyone's talking about. The itch that says, "Your current system is fine, but maybe this new indicator would make it perfect. Your entries are okay, but what if this pattern gives you earlier, tighter ones? Your win rate is decent, but what if this strategy gives you 80% winners?" And that's the paradox. The same mind that wants stability also chases novelty like a child in a candy store. Modern markets make this conflict worse. You're bombarded with new tools, new order flow tricks, new smart money models, new indicator stacks, new edges dropping in your feed every single week. Every time your current system goes through a normal losing streak, which every real system does, that's when the itch kicks in hardest. You start thinking, maybe my system is outdated. Maybe I'm missing a key filter. Maybe that guy on Twitter is right. My whole approach is wrong. And instead of doing what a professional would do, reviewing your trades, checking if you actually followed your own rules, asking if the market conditions have shifted, you do what a system hopper does. You open a new chart layout. You add a new tool. You bookmark a new thread. You quietly demote your current system from foundation to backup, without ever giving it a fair test. This is where Livermore's mindset cuts straight through the noise. He operated in a time with far fewer tools than we have. No algos, no colorful indicators, no army of influencers pushing frameworks. But he still faced the same temptation, to change what he was doing every time the tape stopped being friendly. The difference was, he learned to distrust novelty for its own sake. He believed markets repeat themselves, not in the exact pattern, but in the behavior of crowds, in the way fear and greed show up on the tape. So any method he used had to prove itself across cycles, through quiet times and wild times. To him, a new idea was guilty until proven innocent. To us, most of the time, a new idea is innocent until a few losses scare us away, and we're on to the next one before we ever really knew if the last one had an edge. That's the heart of the paradox. You say you want a system you can trust, but you keep auditioning systems like you're speed dating, never staying long enough with one to see how it behaves in a real relationship, through boredom, stress, and conflict. In the next section, I want to talk about the psychological trap that grows out of this conflict, the untested system loop, how a mix of FOMO, early luck, and impatience trains you to keep abandoning methods before they've truly been tested, leaving you with years of effort, and nothing solid to show for it. There's a loop I had to admit I was trapped in before anything changed. I call it the untested system loop. And if you're honest, you might recognize yourself in it too. It goes something like this. You're frustrated with your current results. Maybe your P&L is choppy, maybe you're slightly down, maybe you're just bored. So you start hunting. You open YouTube, Twitter, Discord, maybe a forum. And there it is, your next solution. A thread with clean charts and circled entries. A video with a perfect equity curve. A backtest screenshot that looks like a staircase to heaven. In that moment, something in you lights up. It's a mix of hope and relief. This might be it. This might be what I've been missing. You study it for a weekend. Scroll some examples. Maybe you manually backtest 10 or 20 charts. The winners stand out clearly in your mind. The losers, less so. And because you're human, you quietly upgrade this idea to a system. Then you do the most dangerous thing a trader can do. You bring it straight into live trading with real money and real emotions, as if it's already proven. At first, you often get exactly what your brain is craving, early wins. A couple of trades work nicely, maybe 3 or 4 in a row. The pattern looks clean. The confirmations seem logical. Your P&L bumps up. And your brain goes, see? I knew it. This works. This fits me. That old system was trash, this is better. You feel smart for switching. You feel validated. The newness feels like progress. Then, inevitably, the other side shows up. The losers, the chop. The market phase where this shiny idea doesn't perform as well. Your next few trades under this new system stumble. You get stopped out more. The pattern that looked so clean suddenly looks muddy. You start asking panicked questions like, did I misunderstand the rules? Is the market changing? Was I only seeing the best examples? But here's the key psychological trap. Because you never truly defined and tested this system, you don't know what is normal for it. You don't know its expected win rate, its average drawdown, how it behaves in different volatility regimes, what its pain looks like when it's actually still valid. So every losing streak feels like proof that the whole thing is broken. And instead of doing what a pro would do, log trades, analyze performance, check if you follow the rules, you do the one thing that guarantees you'll stay stuck. You abandon the system, and go hunting for the next one. That's the untested system loop. Frustration with current results. Discovery of a new method. Shallow research and quick adoption. Early luck and excitement. First real drawdown. Panic, doubt, and abandonment. Back to step 1 with a new name and a new layout. You can waste years in that loop and never actually know if any of your systems had real edge, because you never stayed long enough to gather meaningful data. Livermore, in his own way, had to fight the same tendency. Early on, he hopped ideas too, tips, bucket shop tricks, patterns that worked great until they didn't. What separated his mature phase from his early gambler phase was this. He started to distrust anything he hadn't seen through a full cycle. Bull and bear, calm and panic, low volume and high volume. Until he had watched a method behave under stress, he treated it as an experiment, not a system. And he sized it, tracked it, and emotionally related to it that way. We, on the other hand, tend to treat experiments like finished products, and pay the price. In the next section, I want to step fully into Livermore's mind and explore how he thought about new ideas, how he separated signal from noise, and why he would rather sit in cache than marry a method that hadn't proven itself through the tape. When I look at Jesse Livermore through the lens of systems, I don't see a man who fell in love with new ideas. I see a man who was terrified of them, until they proved themselves. Livermore didn't have backtest software. He didn't have strategy builders or optimizers. What he had was the tape, a notebook, and an unusually brutal honesty about cause and effect. He watched the market long enough to understand something most of us still resist. A trading idea is not a system just because it worked a few times. To him, a method wasn't real until it had survived different market cycles, different volatility environments, different emotional states in himself, and, most importantly, a lot of observation without money attached. He often wrote about studying the action of stocks before committing real capital. This wasn't a poetic phrase. It was his way of saying, I let the idea trade in my head and in my notebook long before I let it trade in my account. And he was especially wary of what we might call cleverness, ideas that looked brilliant on paper but weren't grounded in how crowds actually behave. He knew the human mind loves patterns. We're built to find order, even in noise. Show us 10 charts with carefully drawn lines and we'll see a story. Show us a few winning trades in a row and we'll see destiny. Livermore knew that story feeling was a trap. So before he trusted any new approach, he'd run it through a kind of internal filter. Does this idea align with what I already know about trend, accumulation, and the line of least resistance? Have I seen this type of action, in one form or another, over and over again on the tape? Does this method tell me something simple and essential about price, or is it just complicated decoration? Can I explain the why behind it in plain language, or am I hiding my uncertainty behind fancy terms? If an idea failed those tests, it didn't matter how new or smart it looked. He'd observe it, maybe note it, but he wouldn't let it become the backbone of his trading. That's what he'd distrust in a modern context, not innovation itself, but unearned conviction. He'd look at someone adopting a brand new system after a weekend binge watching videos and say, "You haven't seen that method under fire yet. You don't know what it does when the market turns ugly." Livermore understood that markets have a way of interrogating every idea. In a trending environment, almost everything looks good. In a choppy environment, almost everything looks bad. Under news stress, the true character of a setup is exposed. If a method only worked in the easy parts, he considered it incomplete. If it completely fell apart in turbulence, he'd file it under interesting, but not trustworthy. What he wanted wasn't just a system that could make money. He wanted a system whose behavior he could predict under stress. A system he could stay with during drawdowns because he knew, from experience, this is what it does before it recovers. And that's the piece most modern traders skip. We want the win rate, not the personality profile of the system. We want the equity curve, not the story of how that curve was earned. Livermore's distrust of new wasn't closed-mindedness. It was an operator's understanding that anything untested is just a theory wearing a costume of certainty. In the next section, I want to show you how this played out in my own trading, how I took a shiny, promising new system, trusted it way too fast, and watched it unravel in real time, not because the idea was garbage, but because I treated it like a Livermore-approved method long before it had earned that right. There was one new system that taught me more about this problem than any book ever could. On paper, it was beautiful. In real life, it nearly wrecked a good month. I found it like most of us find these things, late at night, after a frustrating day. I was scrolling through charts and content, annoyed at my own inconsistency, when I stumbled on a thread, clean screenshots, high win rate, elegant rules. It combined a simple moving average with a specific candlestick pattern and a volatility filter. Nothing too crazy. The creator had backtest images, examples, and a calm, confident tone. This works across markets. This is built on pure price. This filters out the noise. I wanted to believe him. More importantly, I wanted to believe that my inconsistency was a system problem, not a me problem. So I did what felt like due diligence. I scrolled through maybe 30 to 40 charts. I circled the winners. I noted a few losers. I thought, yeah, this makes sense. This is logical. I see it. In my mind, the idea quietly got promoted from interesting to valid. The following week, I started trading it live. Not small. Not as a test. As if it were my new main framework. At first, it was everything I wanted it to be. The first 3 trades were winners, clean, almost textbook. The pattern showed up, the signal lit, price moved in my favor. I felt smart for finding it. I felt relieved, like I'd finally upgraded my process. I even caught myself thinking a very dangerous thought. If I just size this properly and stay patient, I can scale this hard. Then the environment shifted. The market went from directional and clean to choppy and headline-driven. The exact same signals still printed on the chart, but now they were firing in noisy, overlapping ranges instead of clear trends. My next few trades under this system got stopped out quickly. No follow-through, fake breaks, wickiness everywhere. And here's where my lack of real testing showed up in full. I didn't know if this was a normal drawdown for the method, a condition it wasn't designed for, or proof that the idea had no real edge, because I'd never actually tested it through past choppy periods. I'd only eyeballed it in hindsight on charts where the trend was obvious. So instead of responding like a professional, reducing size, logging trades, segmenting results by environment, I responded like a gambler whose magic trick stopped working. I started tweaking on the fly. Maybe I'll skip trades that look a little messy. Maybe I'll add RSI here, just as a filter. Maybe I'll only take it with the higher timeframe trend. Within days, I wasn't even trading the original idea anymore. I was trading an improvised blend of half-understood rules, layered on top of live capital, under stress. The system wasn't the problem at that point. My process was. I had done the exact opposite of what Livermore would have done. Instead of observing the idea for weeks, tracking its signals on paper, seeing how it behaved across regimes, then gradually sizing it in. I skipped straight from curiosity to conviction. By the end of that month, the damage wasn't catastrophic, but it was stupid. I had turned what should have been a sandbox experiment into a primary weapon. And the worst part wasn't the money lost, it was the realization that I still had no idea whether that system had real long-term promise or not. I'd never really tested it. I'd only reacted to it. In the next section, I want to walk you into the emotional low point that followed, the moment I looked at my results, felt that old shame rise up, and had to decide whether I'd keep chasing the next new thing, or finally adopt Livermore's harsh, suspicious attitude toward untested ideas. The real punch from that new system didn't land on the day I took the losing trades. It landed a few evenings later, when I finally forced myself to open my journal and look at the month as a whole. At first glance, the damage didn't look catastrophic. I wasn't blown up. I wasn't margin called. I hadn't destroyed the account. But the more I looked, the worse it felt. Because it wasn't about the money anymore. It was about the pattern. There it was in black and white. I'd started the month trading my usual, tested setups. I'd slowly built up a decent cushion, nothing flashy but solid. Then I'd discovered the new system. Shifted my focus, shifted my risk. Got early winners, then bled it all back and more when conditions changed. The equity curve didn't show one big mistake. It showed a pivot point where my behavior changed, from operator to experimenter, from process to impulse. And what really hit me wasn't, this system failed. It was. I did it again. Again, I had elevated an untested idea to main strategy status. Let a couple of early wins convince me I'd found an answer. Refused to accept that I didn't actually understand the method under stress. And then bailed on it the second things got rough, without a proper post-mortem, without real data. It wasn't just this system that was unproven. I was unproven. I realized that if someone had asked me, name one approach you've truly tested over a full year, across different environments, with honest logs, I wouldn't have had a clean answer. That realization brought a kind of emotional low that's different from a big loss. It wasn't panic. It was something closer to disappointment, like looking in the mirror and finally seeing the pattern you've been pretending isn't there. I remember sitting there, staring at the journal, thinking, if I keep doing this, if I keep speed dating systems, falling in love after 3 trades and breaking up after 5 losses, I can trade for the next 5 years and still not actually know if I'm any good. And that's a terrifying thought for a trader. Not just losing money, but losing time, losing years, to methods that were never really given a fair test, or never deserved to be used with real money in the first place. That's when a line from Livermore hit me differently than before. Paraphrased, his idea was, A man can be wrong in the market and still be right in his method. But if his method is wrong, being right a few times means nothing. Up until then, I'd been obsessed with being right in individual traits. Now I saw a deeper problem. I didn't even have a method I could clearly call mine, let alone one I'd truly vetted. Sitting in that discomfort, I had a choice. Blame the system. Blame the market. Go find another shiny idea and start the loop again. Or admit that the real issue wasn't which system I used, it was how I related to new ideas in general. That was the turning point. Instead of asking, which system should I trade? I started asking, how would someone like Jesse Livermore handle a new idea today? How would he test it, size it, doubt it, before ever trusting it with serious money? In the next section, I'm going to crystallize that question into a clear breakthrough principle, the core Livermore lesson behind the untested system problem, and the mindset shift that turns you from a system hopper into a trader who lets ideas earn their place in your playbook. If I had to turn this whole untested system problem into one core Livermore-style rule, it would be this. New ideas start in the notebook, not in the account. That's the mindset shift that separates a system hopper from an operator. Before this clicked, every idea I liked went straight to live combat. I treated my account like a lab table, cut here, inject there, see what happens. And every time, the pattern repeated: early excitement, mid-term confusion, late-stage abandonment. Livermore, by contrast, treated his capital as the final stage of testing, not the first. Underneath his stories, the tape reading, the pivotal points, the big campaigns, there's a quieter discipline. He was constantly watching, logging, and mentally simulating ideas before he turned them into real bets. He understood something we often forget. A trading system isn't just a set of rules that sometimes win. A real system is a set of rules whose behavior you understand through drawdowns, flat periods, regime changes, and your own emotional swings. And the only way to build that understanding is exposure over time, across enough trades and enough environments that your brain stops treating every loss as an emergency referendum on the idea itself. So the breakthrough rule becomes: new idea? Interesting. Looks logical? Good. A few nice examples? Promising. But until it has been tracked for dozens of trades on paper, survived at least one ugly week in your chosen market, and shown you both its good days and its bad personality, it is not a system. It is a candidate. Livermore would have treated it like an apprentice, not a partner. You don't hand the keys to the vault to someone you just hired. For us, that means no jumping full size into a brand new framework. No abandoning your current tested approach mid-month because the new thing feels fresher. No judging the idea off 5 trades and declaring it gold or trash. Instead, the Livermore approach is: observe first. Let the idea trade in your notebook or a tiny sandbox account. Log every signal, win or lose. Profile its behavior. What does its edge actually look like? When is it weak? What kind of losing streak is normal? Earn promotion. Only after it's survived that process do you gradually give it more size and more importance in your overall plan. The deeper lesson? Your edge is not just the idea you trade. Your edge is the way you vet and deploy ideas over time. Livermore's genius wasn't that he never experimented. It was that he kept a thick line between experimenting and operating. Once I started drawing that same line in my own trading, the chaos decreased. I still explored new concepts, but I stopped letting them hijack my entire month the moment they excited me. In the next section, I want to plug this principle directly into our current reality: multiple time frames, algos, social media hype, edge threads dropping every day, and show you exactly how to live this Livermore mindset as a modern trader surrounded by more untested ideas than he could ever imagine. If Livermore walked into our world today, I think he'd be stunned by the tools, and completely unsurprised by the behavior. Because what we're dealing with now isn't a lack of systems. It's a flood of systems, most of them untested, most of them marketed as proven, all of them competing for your attention and your capital. Let me paint a typical modern trading day, and you tell me if this feels familiar. You wake up, and before you've even opened your platform, your phone has already pitched you 3 edges. A YouTube thumbnail promising a 90% win rate. A Twitter thread with a new liquidity model. A Discord message about some indicator combo that nails reversals. None of these ideas have lived through your testing. None of them have been logged across your markets, your time frames, your temperament. But they all carry that same seductive tone: you're missing something. Here it is. Then you open your charts. On one screen is the system you said you'd commit to, a simple trend following or mean reversion play you've actually put some time into. On the other screen is someone's live stream, trading an entirely different method with flashy levels, fast entries, intense commentary. And right there, in that split second, you're living the untested system problem in real time. Do you stay with the boring thing you've been building? Or do you reach for the exciting thing you barely understand? This is where Livermore's suspicion of new ideas becomes incredibly practical. In our world, his rule, new ideas start in the notebook, not in the account, would sound like this. You can watch that new SMC model. You can study that new volume pattern. You can log those signals in a demo or a journal. But you do not let it override your core method or your risk plan until it's earned your trust over time. He'd look at our platforms and see an advantage too. We actually have tools he never had. Demo accounts, tagging and analytics, easy export of trade history, forward testing on replay and sim. To him, these wouldn't just be toys, they'd be the perfect sandbox, places where new ideas belong until they've proved themselves. But what do most of us do? We treat the live account as the sandbox. We experiment where we should execute. We improvise where we should operate. We put our real capital in the role of guinea pig, and then wonder why we feel so emotionally fragile. Modern trading makes one thing incredibly easy: jumping systems. In 2 clicks, you can load a new indicator set, switch to a new instrument, copy someone else's layout. What's hard, and where your edge really lives, is being the trader who resists deploying every new idea instantly, separates exploration time from execution time, knows which part of the day is for learning, and which is for simply running the plan. If Livermore were here, I don't think he'd be anti-innovation. He'd be anti-delusion, anti-overconfidence in things you've barely tested, anti-I saw it work 5 times so I'm going to size up. In a world where anyone can publish a system overnight, your real professionalism is measured by how slowly you upgrade an idea from theory to trusted tool. That's how this applies to us now. You can still explore. You can still evolve. You can still adapt to new information. But you do it in a structured, Livermore-like way. Ideas must survive contact with time and tape before they're allowed to drive your decisions. In the next section, I'm going to turn this into a concrete, step-by-step protocol, a practical workflow you can use to handle new systems, from first discovery, to sandbox testing, to gradual promotion, so you never again let an untested idea hijack your entire trading month. Now let's turn all of this into something you can actually do the next time a new trading idea grabs you by the throat. Think of this as a Livermore protocol for new systems, a step-by-step way to handle fresh ideas without letting them wreck your month or your mindset. I break it into 4 stages: catch, contain, test, promote. Keycap 1: catch. Name the new idea before it names you. The moment a new system catches your attention, YouTube, Twitter, Discord, wherever, you do one simple thing first. You name it and park it. You write in your journal. New idea, name. Source, where you found it. Core logic in 1 sentence: trend following, mean reversion, liquidity sweep. Why? Because this tiny act does 2 things. It stops the idea from living only in your head, where it can morph into fantasy. It sends a signal to yourself: this is a candidate, not my new identity. You're catching the idea before it merges with your self-image as my new system. Keycap 2: contain. Keep it out of your main account. Next, you decide the arena. This idea lives in a demo account, a micro-risk sandbox account, or paper-only notes, but not in your main, serious capital. For at least the first 20 to 30 trades, this method is on probation. Livermore's version of this was mental and on paper. Our version can be cleaner, an explicit line between. Capital I protect. Capital I can sacrifice to research. If you're honest and you see yourself instantly wanting to go full size with it, that's your red flag. That's not edge talking. That's hope talking. Keycap 3: test. Build a behavior profile, not just a win rate. This is where you do the work most traders skip. For every signal this new idea gives, you log date and time. Market condition: trending/choppy/news heavy. Setup type: entry/stop/plan target. Result: win/loss/B. Your emotional state when taking it. Your goal isn't just, does it win? Your goal is, what does this system do across different conditions? After 20 to 50 trades, you should be able to answer. Does it thrive in trends or in ranges? What does a normal losing streak look like for it? 2 in a row? 6 in a row? What's the average or multiple? Does it fit your personality? Can you sit through its drawdowns without going crazy? If you can't answer those questions yet, you're not done testing. You're still in storyland. Keycap 4 promote, gradual sizing, never a coup, only after you've logged enough trades, seen it through at least one ugly week. Confirmed it fits both the market and your temperament. Can you consider promoting it? Promotion does not mean dump my old system, marry this one. It means start with tiny size in the main account. Run it alongside your existing, tested approach. Keep logging. Compare performance and behavior honestly. If it stays consistent over another batch of live trades, then, and only then, you can slowly allocate more risk to it. The rule is simple. No idea jumps from Twitter thread to full-size live system without passing through my notebook and my sandbox first. That's Livermore's distrust of new turned into a modern workflow. If you run this protocol, something interesting happens over time. Your system list stops rotating every month. You stop feeling whiplash from constantly changing approaches. And you gradually build a small, trusted stable of methods that have actually earned their place. In the final section, I want to bring this home with a cinematic conclusion, tying together the danger of untested systems, Livermore's suspicion of new, and the trader you become when you finally stop letting every fresh idea sit in the driver's seat of your account. There's a moment, somewhere deep into your trading journey, where you realize something uncomfortable. It's not that nothing works. It's that nothing has been given a real chance to work. You've lived as the trader who changes systems like wallpapers. New template, new indicator, new model. Each one arrives like a rescue boat, and leaves like a ghost. The market has seen this version of you many times. The trader who trades someone else's backtest with full conviction. The trader who switches methods the moment a losing streak hits. The trader who blames the system, the market, the broker, the spreads, anything but their own process of adopting ideas. But there's another version of you the market hasn't truly met yet. The trader who treats new ideas as suspects, not saviors. The trader who lets systems earn trust through observation, logs, and time. The trader who separates experiments from operations, and never confuses the two. That's the trader Jesse Livermore was trying to become in his later years, the one who no longer trusted a method just because it had a few brilliant traits, but only after it had stood in front of the firing squad of real conditions and survived. You now know the shape of the real problem. It's not that a new system is dangerous. It's that an untested system, treated like gospel, is. You also know the way out. Catch the new idea. Name it. Park it. Contain it in a sandbox, journal, demo, micro-risk. Test it long enough to see its personality, not just its highlight reel. Promote it slowly, if at all, only after it's proved itself in your data, not in someone else's screenshots. And somewhere along that path, something subtle but massive changes. You stop being the kind of trader the market can toy with via every new trend, thread, or thumbnail. You become the kind of trader who can say, calmly, interesting idea. Let's see how you behave over 50 trades. That sentence alone separates professionals from the crowd. So let me ask you this, and I want you to answer it honestly. Comment below. What is one specific rule you're going to adopt from this video for handling new systems? Will you require 20 to 50 paper trades before risking real money? Will you keep all new ideas in a separate sandbox account for a month? Will you refuse to abandon your primary system until you've reviewed at least 50 logged trades? Write it. Commit to it. Because the moment you stop letting untested systems drive your decisions, you don't just protect your capital, you start protecting your years. Livermore learned it the hard way. New ideas are not the enemy. Undisciplined adoption is. Trade well. Test slowly. And never again let a weekend's worth of excitement dictate a month's worth of risk.